We are all really just one decision away from changing our lives forever. That's a fact, and today you're about to learn how to do just that, financially speaking, of course, by way of generating passive income through arguably the easiest investment strategy known to the modern day investor: dividend investing into exchange-traded funds. Now, depending on your age, investment timeline, and risk tolerance, you're actually going to want to pay very close attention because, let's just be honest, most investors are just doing this whole investing thing wrong. With that being said, are you ready? So if you're anything like me, or the scores of investors out there who came before me trying to get rich by Tuesday and become the next Ray Dalio, Warren Buffett, or Charlie Munger, I want to stop you dead in your tracks right now before you decide to actually do more damage to yourself and lose more money in attempts to try to get rich by Tuesday. Because the reality is, you'll pass up a phenomenal opportunity for some stellar returns, all for a gambler's high with the fool's gold that's out there in the stock market. But there is just a better way, and a matter of fact, a way that has been proven to make more middle-class millionaires than not. Now, before I dive in any further, I want you to think about this. Over its history, the S&P has generated an average annual return of 9%, including reinvested dividends. At that rate, a middle-class income is enough to become a millionaire over time, with just about $500 a month, which is less than the 10% of the median U.S. household's monthly income. That's right, nothing fancy, just the S&P itself would have done the trick. However, if you're motivated by passive income like myself, or actually in need of it, then dividend ETFs will need to play a larger role in your investment strategy. So today, we're going to go ahead and discuss what exactly you should be doing if you're earlier on in your investment career, middle-aged, or closer to retirement. Because at each of these stages of your life, you should actually be investing accordingly to that stage. Now, don't think each ETF mentioned is just exclusive to each age group. These are just my personal thoughts and suggestions. So if you're just starting out, maybe in your 20s, you have time and a lot of time working in your favor, but more than that, you can actually afford to take risks because of the amount of time that you have. Just ultimately means that I'm going to tell you some real truth here. When it comes to ETFs or dividend investing, your big focus should actually just be in scaling a rock solid foundation. And you should do that with Vanguard's S&P 500 ETF, ticker symbol VOO, or a similar ETF that tracks the S&P would do just fine. Now, we're talking about a fund when it comes to VOO that's representative of the 500 largest U.S. companies and ultimately offers very high potential for investment growth over the course of the long term. And given the S&P's sheer reliability, a true set it and forget it type of investment fund here for you, well, you can not only sleep at night, but you can literally hibernate. Now, as of this video, we're talking about direct exposure to tech at 32.5% of the fund's weighting, 12.4% worth of the holdings there in the financial sector, 11.7% of the fund's weighting in healthcare, 10% in consumer discretionary, and another 9.3% safely invested in communication services, which all works out to holdings like Microsoft and Nvidia as the fund's largest holdings, followed by Apple, Amazon, Meta, Google, Berkshire Hathaway, Eli Lilly, and Broadcom. And while you'd specifically get invested into a VOO for the growth over the long term and a lot of reliability, it will also reward you with dividends along the way with a 1.27% dividend yield. All for the low cost of just $3 per $10,000 invested annually, thanks to a very low expense ratio coming in at just 0.03%. But here's the true magic of keeping your money in VOO. If you invested $10,000 10 years ago into VOO, well, you'd be sitting on now $33,327.70 today. Now, another fund to really consider, once again, just considering your ability to take on a lot more risk, that is also just an absolute growth-oriented powerhouse, is Vanguard's Information Technology ETF, ticker symbol VGT, which is 100% tech-focused, and with our entire future being tech-oriented, there's really zero reason why younger investors shouldn't be all over such an ETF like this one, as the fund seeks to track the performance of a benchmark index measuring the investment return of stocks solely in the tech sector, while passively being managed to cut down on all the expenses for you and me, meaning you're only going to pay $10 per $10,000 invested annually into this fund, which is next to nothing considering a $10,000 investment made 10 years ago into VGT would have meant a whopping $68,243.74 today, which is the power of investing into tech, as already stated. That is our entire future. Now, this fund will give you exposure specific to the tech sector, of course, but we're talking about subsectors with 29.9% worth of the fund's weighting in semiconductor stocks, 22.2% worth of the fund's weight in systems software, while 18.1% of the fund's weighting is in hardware, another 13.4% in application software, and 4.3% in semiconductors or materials there, before spreading thinner into subsectors, which ultimately grants you positions in Microsoft and Apple, Nvidia, Broadcom, Advanced Micro Devices, Adobe, Salesforce, Oracle, Qualcomm, and Applied Materials. And while none of those companies actually pay a hefty dividend, the reality is the ETF itself would divvy out a nice 0.49% dividend yield. Now, investors, before we actually kick it into gear with some ETFs for the middle to more than middle-aged investors out there, I'm calling on each and every one of you to subscribe to the channel. If you haven't done so already, you're going to become a part of this community and instantly gain access to the latest dividend stock ideas, all the latest macro insights, and of course, just be there for every single Masters of the Market chat. And while you're at it, it would mean a great deal to me and go a long way in helping me spread the word for this channel if you go ahead and tap on that thumbs up button. That keys me in that you're getting value from videos like these, so I just keep making more of them. With that, we might as well just talk about another Vanguard ETF, but bearing in mind this one's for the investor avatar out there needing to reduce some risk, or the investor who's unable to stomach all the market jitters, or even just an investor seeking a little bit more of a balanced mix of growth and higher yields when it comes to dividends. We have the Vanguard High Dividend Yield ETF, ticker symbol VYM, which is an ETF that tracks the performance of the FTSE High Dividend Yield Index, targeting stocks that are forecasted to have above average dividend yield. So again, a little bit more of a bump in the yield, which comprises of 553 holdings collectively, with most of the fund's exposure within the financial sector at 20.5% before tapping into the industrial sector at 12.6%, healthcare at 11.8%, tech at just 11.1%, and energy at 10.4%, all ultimately working out to the top 10 holdings being Broadcom, JP Morgan, ExxonMobil, Procter & Gamble, Johnson & Johnson, Home Depot, Merck, AbbVie, Walmart, and Bank of America, which, as you could probably tell, aren't the riskiest bets in the market, but some staple names that always deliver. And a matter of fact, they would have delivered through on $15,314.25 should you have invested $10,000 10 years ago, which also factors in that dividend coming in at 2.85% for a low expense ratio of just 0.06%, meaning $6 per $10,000 invested annually. But now, in straying away from Vanguard, we can check into Charles Schwab with the all-famous Schwab US Dividend Equity ETF, ticker symbol SCHD, which was designed to track as closely as possible for all the fees and expenses the total return of the Dow Jones US Dividend 100 Index, meaning it targets quality and sustainability when it comes to dividend payers. Of course, SCHD has been dubbed the dividend investor's gold standard, which has made it appear to be the best thing since sliced bread, to which I honestly have to say that's debatable. But let's have a look here at what we're getting into when it comes to the fund profile, as we're going to gain a basket of 103 holdings if we invest into SCHD, breaking down to the financial sector at 17.42%, healthcare at 15.71%, consumer staples and industrials at 13.89% and 13.51% respectively, as well as the energy sector totaling out to 12.84% of the fund's weight, working out to Home Depot and Amgen, UPS as the three largest holdings in the fund, followed by BlackRock, AbbVie, Cisco Systems, Chevron, Coca-Cola, Lockheed Martin, and Texas Instruments as the largest holdings in the fund. But now, performance-wise, we do see that SCHD just outshines VYM, as a $10,000 investment made 10 years ago would have amassed $28,241.20 today, while dividends would have been paid out all along the way thanks to a strong dividend yield coming in at 3.7% for a low cost of just $6 per $10,000 invested annually, with that expense ratio at 0.06%. But now let's say that you're nearing retirement, or you're in retirement right now and you need income. Well, it's going to be the higher yielding dividend ETFs that you're going to look to target, and these two are, in my opinion, well, some of the best bets. We have the High Yield Equity Dividend Achievers ETF, ticker symbol PEY, which according to the fund's description is based on the NASDAQ US Dividend Achievers Index, and the fund will ultimately invest at least 90% of its total assets in dividend-paying common stocks that comprise the index, while stocks are selected on the basis of their dividend yield, as well as their consistent growth in that dividend that they're shelling out, leading to the fund to position itself well into various sectors, from the financial sector at 26.38%, utilities at 23.61%, consumer staples at 15.62%, as well as communication services at 9.05%, and industrials at 8.2%, which means the top 10 holdings work out to Altria Group, First Interstate Bank System, System, Cogent Communications, Universal Corp, Verizon, Key Corp, Truist Financial, Walgreens, Pfizer, and WestBanco. Some of these names are likely not as familiar to you, but others very much may be. But either way, we're talking about a 4.4% dividend yield to collect on with this fund, with a hefty management fee coming in though at 0.4%, meaning $40 per $10,000 invested annually. However, for some, that may not seem like the biggest deal in the world, considering a $10,000 investment made 10 years ago would have ultimately turned into $24,678.04 today. Now, rather recently, options-oriented ETFs have become the hot topic, and quite honestly, many of them I'm actually not a fan of. But some, like the JP Morgan Nasdaq Equity Premium Income ETF, ticker symbol JEPQ, I see as a great choice for active retirees looking for more income and firepower, and you can earn it with JEPQ, given the fund seeks to deliver monthly distributable income while granting investors with Nasdaq 100 exposure, but focused on ensuring less volatility, yet utilizing call options to generate monthly cash flow for you. So with JEPQ, we are talking about a dividend yield coming in at a whopping 9.87%, thanks to 98 holdings within the fund, with Apple and Microsoft as well as Nvidia being the top 3 holdings, followed by Amazon, Google, Meta, Broadcom, and Tesla. But overall exposure in communication services coming in at 12.3%, and consumer discretionary a little bit safer there at 10.9%, before spreading thinner into consumer staples at 4.7%, so on and so forth. And because the fund was basically established a few years ago, we cannot go back an entire decade, but since the date of inception, the JEPQ fund has been performing quite well, pretty bulletproof here, returning $3,919.50 to shareholders if they invested $10,000 at the date of inception, which is not too shabby, while delivering through on a rock solid dividend yield along the way, and of course just a 0.35% expense ratio. That means $35 per $10,000 invested annually. But ultimately, investors, I want you to note that the S&P over the long term is really just one of the best bets that you can make as an investor. And especially if you're a young buck just getting started, go with the S&P, keep it simple, and then maneuver your way through the stock market as you enter different periods of your life, whether you need more dividends with higher yields, but just focus on total return. That is the best recommendation that I have for you to ultimately enjoy your entire life, your entire journey in investing. Now, I want to know if you have any of these ETFs within your portfolio, how you've been performing with them, if you plan on buying them, or if you have better dividend ETFs than mine. Comment all your thoughts and insights down below. Subscribe to the channel. But of course, I'm going to toss you the alley hoop now. Go ahead and click right here for more insights now.